Commerce, money, and banking G-1. S3. Commerce. Money and banking. Money and banking is one of the aids to trade which facilitates trade by offering various services like lending money, giving financial advice, safeguarding money and making it available to the owner's account holders on demand. Money is anything generally acceptable as a means of exchange for goods and services and in settlement of debts. Before money was introduced, trade was carried out by means of bartering. Barter trade refers to the direct exchange of goods for goods and services for services or services for goods. Advantages of barter trade. It eliminates the risks involved in carrying large sums of money, e.g. robbery, theft, etc. It does not involve legal documents when exchanging goods, thus easy and simple to conduct. It solves the problem of currency differences since it does not involve converting local currencies into foreign currencies. It promotes social relationships between the parties involved in the exchange. It saves a country's scarce foreign reserves exchange to be used for importation of only essential goods. It reduces on the depletion/exhaustion/overexploitation of the country's natural resources as it is with the monetary system. It solves the country's balance of payment problems as expenditures on imports. Commerce, money, and banking G-1. Disadvantages of barter trade. Problem of indivisibility of some commodities. Barter trade does not encourage division of certain goods, e.g. a goat for a kg of sugar. At times one had to buy in excess of his requirement. Lack of double coincidence of wants. It was difficult for an individual to find or get someone who had exactly what the other wants. Difficulty in transporting bulky goods, i.e. some commodities are heavy and bulky, thus difficult to carry from one place to another for exchange. Difficulty to store some goods. Some commodities are perishable and cannot be stored for a long period of time without losing value, thus making it hard for exchange. Lack of a standard measure of value. It is quite hard to value a commodity in terms of another, e.g. how many jerrycans of cooking oil could be exchanged for a cow. Barter trade provides no means for deferred payments. Future trade in this limits the use of loans. The evolution of money. Due to the problems encountered in barter trade, it was important to introduce monetary trade. Monetary trade refers to the exchange of goods and services using money as a medium of exchange, i.e. banknotes and coins. However, these are of relatively recent origin. Forms of money. 1. Commodity standard/money. Here different commodities or items we used as a medium of exchange, e.g. salt, cowrie shells, beads, clothes, cattle, etc. 2. Metallic standard/money. Different metals were minted into coins to serve as money with fixed value. 3. Paper money/banknotes. Paper money was introduced to overcome the problem of metallic money which was bulky and becoming scarce. Commerce, money, and banking G-1. 8. Intrinsic value. This is the value of the material in which money is made, e.g. coins have a higher intrinsic value than paper money. 9. Extrinsic value. This is the face value of money, e.g. a 20,000s bank note has a higher extrinsic value than a 10,000s bank note. 10. Standard of full bonded money. This is money whose intrinsic value is equivalent to its extrinsic value. 11. Bank deposits. This is money kept in a bank in a customer's account. Qualities of money. For any item to be used as money, it must possess all or most of the following characteristic. General acceptability. Money should be generally accepted by everyone in the exchange of goods and services and in settlement of debts. Scarcity. Good money should be relatively scarce in supply to enable people work for it. Durability. Money should be durable, i.e. it should not wear out quickly. 8. Should be in position to last for relatively a long period of time. Homogeneous/uniformity. Money of the same denomination should be the same uniform in all aspects such as size, color, etc. Divisibility. Good money should be easy to divide into small denominations to allow small transactions to take place. Portability. Money should be light and easy to carry from one place to another, whether in large amounts or small amounts. Identification/recognizability. Good money should be easily identified and recognized from other materials so that it is freely accepted and used. Stable in value. Good money should be fairly stable in value so that people can use it for current and future dealings in order to maintain its worth and importance. Malleability. Good money should be cheap and convenient to print and mint so that the worn-out old notes and coins can be replaced. Commerce, money, and banking G-1. Functions of money. Money acts as a medium of exchange for goods and services, i.e. people can get what they want by use of money. Money acts as a measure of value in that the worth of different items are valued in money terms. Money acts as a store of value wealth, i.e. a person whose wealth consists of perishable goods like milk, vegetables, fish, etc. can sell them for money and keep that money till he needs them. Money provides a standard for future payment, deferred payment, i.e. money can be as a means of settling debts for goods taken on credit can well be used to pay for loans. Money acts as a unit of account as all business transactions and records are expressed in terms of money for proper accountability. Money enables transfer of immovable properties, for example land, buildings, etc. Reasons why people hold money. Demand for money. 1. For transaction motive. This is when consumers and business people hold money in cash form to enable them meet their current needs like buying food, transport, buying clothes, leisure, etc. 2. For precautionary motive. This is when people hold money for the purpose of meeting unexpected or unforeseen problems or happenings like death, sickness, visitors, accidents, etc. 3. For speculative motive. This is when people hold money in cash form because of expecting prices to fall or rise in future. When prices are expected to fall in future, people will hold money so as to buy more goods at low prices and vice versa. Commerce, money, and banking-1. A bank is a financial institution that accepts deposits, safeguards money received, makes it available to its true owners on demand, and advances loans to those who need financial assistance. Types of banks: central banks, commercial banks, saving banks, merchant banks, development banks, specialized banks. 1. Commercial banks. These are financial institutions which offer a wide range of banking services to their customers and are of particular importance to business people. Functions of commercial banks: they accept and safeguard money deposited by their customers on different accounts, i.e. they offer a safe place for keeping extra cash. Commercial banks extend short-term loan and overdraft facilities to their businessmen and the public, hence providing them with working capital. They provide night safe services to their customers, i.e. depositing and withdrawing money after working hours. They provide a face custody for valuable items and other documents for their customers, such as land titles, certificates, precious minerals, etc. Commercial banks assist businessmen with financial and investments advice and also advise them on how to manage different commercial enterprises. They act as trustees on behalf of their customers, i.e. they manage the properties of the deceased person for the benefit of his dependents. They act as referees for their clients applying for credit facilities from a supplier who wish to make a credit status inquiring before accepting. Commerce, money, and banking-1. They assist traders in international trade by guaranteeing payment to overseas suppliers after obtaining permission from the central bank, i.e. issuing letter of credit. Given responsibility, commercial banks collect money on behalf of their customers, for example rent, water bills, electricity bills, etc. They also issue travelers' checks and sell foreign currency to their customers in approval from the central bank. They may buy and sell bank/securities on behalf of their customers. They assist the government central bank to implement monetary policies like controlling money in circulation. Problems faced by commercial banks: lower deposits. Majority Ugandans are poor. Some do not need the services of commercial banks and others are ignorant/lack trust in commercial banks. Loan defaulters. Bank debtors are at times reluctant to pay loan, causing losses to banks. Political insecurity. Some part of the country are not accessible by banks due to insecurity, making it difficult for banks to extend their services in such areas. High rates of inflation, which makes the interest rates charged to borrowers high, hence discouraging the would-be potential borrowers. Customers. High interest rates on loans advanced by commercial banks scares away potential borrowers, which affects the lending activities of commercial banks. Forgery and money laundering, which results on massive/gross loss of money by commercial banks. High levels of liquidity preference and poor saving habits among the public. Stiff competition among commercial banks due to over-competition in urban areas. Government stringent restrictive monetary policies guidelines on commercial banks affects their lending activities. Dishonesty of workers and robbery/theft, making commercial banks operate in great losers. Commerce, money, and banking-1. Roles of commercial banks in development. They contribute towards increased government revenue through taxes. They encourage capital formation by mobilizing saving. They facilitate government programs like Operation Wealth Creation. They implement monetary policies designed by the central bank, e.g., controlling money in circulation, credit control. They provide employment to the nationals, especially if they are indigenous banks. They increase the productive capacity within the country/economy, since They give loans to investors in various key sectors like agriculture. Commercial banks facilitate international trade by guaranteeing payment to overseas supplies. 2. Development banks. These promote social economic development of the nation by taking services to places where they are non-existent or where shortages are severe obstacles to development. Their main aim is to finance medium or large projects in the country by giving the loans both cash and physical assets. 3. Savings banks. These banks mainly intend to provide a safe place for keeping money and promote the habit of thrift saving among people, especially low-income earners. They accept small deposits and pay interest on such deposits. Examples include Postbank Uganda. 4. Merchant banks. These specialize in accepting and discounting bills of exchange and assisting traders in international trade. They serve financial institutions and individuals with large sums of money. They lend money on medium and large-term basis. 5. Specialized banks. These serve special type of customers and are aimed at providing a special service, i.e. cooperation banks, which mainly serve cooperation societies. Agricultural development banks, which serve farmers, etc. Commerce money and Banking-1. 6. Central banks. This is a government financial institution established to guide, control and assist commercial banks and other financial institutions in the country. It also provides banking services and financial advice to the government. Types of accounts offered by commercial banks. These are basically 3 types of accounts, namely savings account, fixed deposit account/time deposit account, current accounts. Savings accounts. The major purpose of this account is to encourage saving habits among the public, especially the low-income corners. The customers use a pay-in slip to deposit money in his account and a withdrawal slip to withdraw money from his account. Savings accounts are provided by commercial banks, savings banks, and usually opened by the low-income earners. Features of savings account. A minimum initial deposit is required when opening up the account. A minimum balance is maintained by the account holder on his account at all times. A withdrawal is only allowed once a week to enable the account holder accumulate more savings. A small interest is paid on money deposited by the customer on his account. No overdraft facilities are offered to account holders. However, a balance on the savings account can be used as security when applying for a bank overdraft against a current account if a customer operates both accounts in the same bank. Passbook facilities are offered to account holders for depositing and commerce money and Banking-1. Fixed deposit account/time deposit account. A minimum amount is used to open up a fixed deposit account for a specified period, and no withdrawal is allowed before the expiring of that period. This account is suitable to people with large sums of money which they do not intend to use in the near future. Features of a fixed deposit account. A minimum deposit is required when opening up the account. Withdrawals are only allowed/made at the end or expiring of the deposit period. It involves large sums of money. A high interest is paid on money deposited on a fixed deposit account. A deposit receipt is issued to the account holder on opening up this account and when withdrawing money from his account. No checkbook facilities are provided to this account. Deposits on this account can be used as a security to apply for an overdraft against the current account of the same person in the same bank. No, an account holder is given a receipt which is presented to the bank when withdrawing money at the end of the specified deposit period. It indicates full names, address, amount deposited, interest offered, length of time the money is to be withdrawn from the bank. A current account. This is the type of account offered by commercial banks on which money can be deposited and withdrawn at any time on demand. It is the most suitable type of account for the business people who may make regular deposits and payments to their creditors. Commerce money and Banking-1. Features of a current account. A minimum deposit is required when opening up a current account. No minimum balance is maintained on this type of account, i.e. one can withdraw all his money from his account. Deposits can be any time on a current account. Withdrawals are allowed to be made at time on demand during working hours. A checkbook is issued to a current account holder to enable him withdraw and deposit money on his account. Usually no interest is given on money deposited on a current account. Bank statements are issued to customers on a monthly basis or on demand. A bank statement is a record of all transactions a current account holder had with his bank during the month. Bank overdraft facilities are offered to current account holders and a small interest is charged by the bank. How to open up a current account. A person wishing to open up a current account is required to 1. Furnish the bank with an introductory letter from his employer, his identity card, and if self-employed would be required to present a letter from the local council. 2. Fill in the application form provided by the bank with all the necessary details, e.g. the full names, the address and occupation. 3. Name 2 referees who should be customers to that bank. 4. Sign a signature card on which the specimen signature is displayed, and this may appear on all bank documents that are signed by the account holder thereafter. 5. The applicant is required to pay the minimum deposit to open up the account. 6. An applicant is issued with an account number which will appear in his transaction documents. Commerce Money and Banking-1. How to withdraw money from a current account. A person wishing to withdraw money from his current account must draw a check and show the date, name of payee, amount, signature, etc. Check. A check is a written order by a current account holder to his bank customer, authorizing his bank to pay a specified sum of money to a named person on its face or his order on demand. Format of a check. Commerce Money and Banking-1. Account number of the drawer. Name of the drawee / name of the bank / bank branch. Check number. Parallel crossings for the case of cross checks. Serial number. Parts of a check. A check has 2 main parts. A counterfoil / check stub. It is the part of the check that remains in the checkbook after a check leaf has been turned out. It contains a summary of the information on the check leaf and it evidences payment made to a named person. It is used for record purposes, and it is also referred to as a check stub. B. A check leaf. It is the part that is torn out from the checkbook to be presented to the bank by the payee to withdraw money from a current account. Parties to a check. Drawer is a person who writes and signs a check, i.e. a person demanding payment. Account holder. Drawee is the bank on which the check is written. Payee is a person to whom the check is addressed. At times the drawer can at the same time be the payee. Advantages of paying by check. It is very convenient and saves time. Writing a check takes little time and counting a large number of currency notes and coins. A single check can be used to settle various debts or pay money to many. Commerce Money and Banking-1. It is easier to store a check than cash, especially if it is in large sums. It is very safe. Cash can easily be stolen, but a check can't, especially if it is cost. It is easy to carry a check as compared to cash in large sums, i.e. a check is portable. A check facilitates easy transfer of money from one bank to another, without money physically leaving the bank through the clearinghouse. A check acts as a receipt once it is cancelled. It is evidence that money has been received and no further receipts are required. The counterfoil in the checkbook acts as a record of payment for the drawer. Cross checks ensure accuracy of payment. Traveler's checks can be used for making payments to distant places. Postdated checks can be used to postpone payment to a future date. It is easier and cheaper to send large sums of money through the post office, with no extra costs. Disadvantages of paying by check. Using checks is expensive since checkbooks are paid for by the account holder. Restricted to only those who have bank accounts. Used by only those who can read and write literates. Failure to access cash immediately, especially if postdated check. Possibility of dishonoring it, unlike cash, which is a legal tender. Checks take time to mature. It is risky in case of a bearer check. Once it is stolen, cash can be withdrawn. Checks are time-consuming as a payee is required to go to the bank and present if for payment. Commerce Money and Banking-1. Open checks. These are checks payable across the counter and may be made payable to anybody holding the check or to a named person or his order, i.e. to anybody else whom the payee may name. An open check may be black small square cash check, black small square hen, order check, or black small square a bearer check. A cash check is one where the person presenting it is the drawer. In this case, the check bears the writings pay cash. An order check is one payable to the person named on it, i.e. it is a check where a payee is named. For example, pay Nadia. A bearer check may be made payable to any person who may possess it. In this case, nobody is named on the check as pay. It is expressed as a pay cash or pay bearer. This type of check does not require endorsement when being transferred to another person. Endorsing a check is when a person named on it transfers the right to receive money against it to another person by signing his name and putting the name of the new payee on the back of the check. Note, the one signing / endorsing is the endorser and the new payee is the endorsee. Cross check. A cross check is one that bears 2 parallel lines called crossings across its face. A cross check cannot be presented for payment across the counter. It must be deposited to the bank, which enables it to trace the payee. Crossings may be general or special. General crossings. These may take the following forms. Commerce money and banking G-1 are just two parallel lines with no words between them. The two parallel lines with words and company between. Then, these words, however, do not have any significance. See two parallel lines with or, without the word and, company, but with the words not negotiable between. Then, the words signify that the payee named on the check can transfer the right to receive money against the check. The new payee endorsee will not have a better title to the check than the original payee himself had, so it should not be endorsed to another person in settlement of his debt. This means that the payee cannot endorse the check to another person, but the money should be paid to the payee's account only named on the check. Special crossings. The two parallel lines with the words /C payee only. Commerce money and banking G-1. Special crossings consist of two parallel lines with the name of the bank and branch between them to which it should be presented. A specially crossed check can be presented for payment only through the bank and branch named between the crossings. The words not negotiable and account payee only may be added to a special crossing to make it more effective. Special crossings may also be used to indicate the amount payable against the check, i.e., writing between the crossings the amount e.g. not exceeding SHS 400.0. Making alterations on the check. If the drawer wishes to change anything on the check, he must write the alterations above clearly and sign his full signature above the alterations. For example, opening a crossed check. If the payee has no account on which he can be paid using a crossed check, or if the drawer wishes to obtain cash from the bank and yet all his pay cap or derrick. Commerce money and banking G-1. Checks are printed crossed. Such a drawer may cancel the crossings by stamping the face of the check with the words crossings cancelled, please pay cash, etc., followed by his signature. 3. Traveler's check. This check is issued by the bank in fixed denominations to a person or businessman who pays for it in advance. Traveler's checks are issued to those customers making many journeys to enable them avoid carrying large sums of money in cash. A small service fee is charged. The bank issues the traveler with check leaves and asks him to sign them in the presence of a bank officer. When presenting these checks for payment, the holder must countersign the checks in the presence of an officer of the paying bank. The two signatures will be compared, and if found similar, payment would be made against check. A person may also be called upon to prove his identity. This makes traveler's checks very safe because if stolen, they cannot be cashed. There are two types of traveler's checks, namely, inland traveler's checks. These are used within the territory of a given country. International traveler's checks. These are issued in one country and cashed in another country. Commerce money and banking G-1. Terms used to describe checks. 1. Stale check. This is a check that has not been cashed within 6 months from the day it was written. Such a check cannot be accepted or honored by the bank. It is an expired check. 2. Post-dated check is a check presented to the bank before its maturity date. 3. Stop check is a check to which the drawer instructs the bank not to honor, e.g., if he discovers the check was stolen, he can instruct the bank not to effect payment. It is a check for which payment has been stopped by the account holder. 4. Blank check is a check which is incomplete, say missing the amount, date, or signature of the drawer. Blank checks are risky because someone may fill them and withdraw more money from the drawer's account. 5. Forged check is a check with a forged signature or amount. 6. Cancelled check. It is a check that has been paid by the bank. Such checks are marked with the word cancelled on their face, making a check secure. Always make crossings on the check because such checks cannot be passed across the counter. They are always deposited in the bank and only cast by the person to whom they are made. Never leave unnecessary gaps between words and figures when writing a check. Avoid signing blank checks because these tempt people to withdraw more money than they should have. Always report loss of checks to the bank or police as soon as possible. Always keep the checkbook locked in a safe place to avoid loss. The drawer should ensure that his signature is not easy to forge since an imposter can counterfeit it and withdraw money from his account. Commerce money and banking G-1. Dishonoring a check. This is when the bank refuses to effect payment against a check. Circumstances under which a check may be dishonored. If the drawer has insufficient funds on his account with the bank. If the check is dishonored for this reason, it will be marked insufficient funds. R/D. When the drawer is insane or dead or bankrupt. when the drawer instructs the bank not to honor the check. If the check is stale, i.e. presented 6 months after the date on it. When the check has an error on it, e.g. the amount in words and figures do not agree. In case the check is post-dated, i.e. if the check is presented for payment before the date on it or before maturity. If the drawer has closed his account with the Drawi Bank. If the check is not signed by the drawer, or if the account has 2 signatories but the check is signed by 1 person instead of 2. In case there are alterations on the check and are not countersigned by the drawer himself. If the signature on the check differs from the specimen signature held by the bank. If the check is mutilated, i.e. if the check is too old or torn. Reference questions. 1. Explain 5 reasons why the business community in Uganda prefers current accounts to fixed deposit accounts. B. Describe the process of opening a current account. 2. Outline any 6 merits and demerits of using a check as a means of payment. Commerce money and Banking-1. B. Under what conditions may a check be referred to the drawer by the bank? 3. Why are checks not commonly used by the business community in Uganda? B. Outline the problems faced by commercial banks in Uganda. 4. Explain the benefits of commercial banks to consumers. B. Give any 5 factors which managers of commercial banks may consider before giving loans to borrowers. 3. Commerce, money and banking continuation. Bank loan. A bank loan is a large sum of money lent out by the bank to its customers for a fixed period, a fixed rate of interest, and usually backed up by collateral security. It can be on short-term given for 1 year, a long-term, over 10 years basis. Factors considered before granting a loan. The purpose for which the loan is required. The bank may not lend money for a wedding, but can do so for buying land or starting business. The personal integrity and creditworthiness of the borrower. A creditworthy person and with strong moral principles can easily get a loan than one who is not and without strong moral principles. The amount of the loan required by the borrower. It is easy for the bank to lend a reasonable amount than a big loan. Assets in relation to the liabilities of the borrower. A bank can readily lend to a person with more assets than liabilities. The collateral security the applicant is offering. Commerce money and Banking-1. This induces the bank to advance a loan more easily than where there is no security. The length of time for repayment. Short-term loans are easier for the bank to lend out than long-term loans. The prevailing government policy concerning lending, where the government may instruct commercial banks to limit credit, the loan may not be advanced and vice versa. Nature, value and marketability of the collateral security. The bank can easily lend money against a high value and marketable security than one of low value and less marketable. Likely profit for the bank. The higher the profit the bank will make from the loan, the easier it is for it to give a loan and where there is a possibility for the bank to make a loss. Risks involved in the proposed project. The bank may easily advance a loan where there are limited risks and where there are high risks. 1. A central bank. A central bank is a national bank of any country managed by the government to control and guide other financial institutions in the country. It is responsible for issuing new currency. It is an important bank in the country which also assists and advises government on financial matters. The central bank in Uganda is called Bank of Uganda BOU. Functions of the central bank. Bank of Uganda. Issuing of currency. The central bank is responsible for issuing currency, i.e. it controls the process of printing bank notes and minting coins. Therefore it takes the responsibility of issuing new currency and replacing the worn-out paper notes. Commerce money and Banking-1. The central bank provides banking services to government by receiving deposits on behalf of the government from various sources, e.g. income tax, custom duty, etc. Lender to the government. The central bank is one of the sources of short-term income to that government, i.e. the government borrows money in various forms from the central bank. This money can be in form of a public debt. A public debt is money borrowed from the public through commercial banks on behalf of its people, or it is any money due by the government to its people. The central bank is also responsible for controlling government borrowing and to pay back government debts. So it manages the public debt. Advisor to the government. The central bank, through the Ministry of Finance and Economic Planning, advises the government on financial matters, for example, on how to control inflation in the country, how to raise short-term finance for government projects, the best projects to invest in. 2. Exchange control. It controls foreign exchange or currency in the country by restricting the upflow of foreign currency to other countries. This foreign currency can be used to pay for imported goods and services. It acts as a banker to international agencies. The central bank provides banking services to international agencies working within the country like the International Monetary Fund (IMF), World Vision, Red Cross, etc. It acts as a banker to commercial banks. It provides banking facilities to commercial banks in the country, i.e. all commerce money and Banking-1, lender of last resort to all commercial banks. The central bank is not basically a money lending institution, but it does sometimes lend money to the government, commercial banks and other financial institutions when there is no other source available for borrowing. Hence acts as a lender of last resort. It supervises and controls commercial banks. The central bank directs and controls commercial banks on all financial matters important, e.g. lending money to the public. Credit control. This is an act taken by the central bank to control the lending capacity of commercial banks in order to ensure that there is just the right amount of money in the economy. Usually a loan granted by a commercial bank increases money in circulation, hence need for credit control. There are two policies employed by the central bank to control credit, i.e. monetary policy and fiscal policy. 3. Monetary policy. This refers to deliberate attempts and measures taken by the government to control and regulate the amount of money in circulation. Tools of monetary policy: credit control. There are tools used by the government through the central bank to ensure that there is a reasonable amount of money in circulation so as to maintain the value of its currency. The tools include bank rate increasing/reducing. This is the rate of interest charged by the central bank on any short-term loan it may advance to commercial banks. When there is a lot of money in circulation, the central bank will restrict borrowing by raising the bank rate at which commercial banks borrow from the central bank. Commerce money and Banking-1. This process forces the interest rate up and hence discourages borrowers, thus reducing the amount of money in circulation. On the other hand, if there is little money in circulation, the central bank will encourage borrowing by lowering the bank rate. This means that the commercial bank will also reduce the interest rate charged to the public, thus encouraging borrowing, which will lead to increased amount of money in circulation. Open market operation, OMO. This involves the sale and purchase of government securities, i.e. treasury bills, bond and stock, to and from the public respectively. When there is too much money in circulation, inflation, the government through the central bank will sell securities to the public, which will result into withdrawing of money from the public, hence reducing it in circulation. NB, any money received through the sale of these securities is frozen, i.e. withdrawn from circulation. On the other hand, if there is little money in circulation, deflation, a government through the central bank will buy securities from the public, hence putting more money in circulation. 4. Compulsory or special deposits. This is an additional amount of money beyond the legal reserve requirements, which commercial banks are required to deposit in the central bank on their accounts. If there is too much money in circulation, the central bank may instruct commercial banks to deposit more money on their central bank accounts. This reduces the amount of money available for commercial banks to lend, while during deflationary periods they are requested to withdraw from their accounts. This increases the amount of money for commercial banks to effect their lending, hence controlling the amount of money in circulation. Selective control. Commerce money and Banking-1. This is when the central bank directs or requests all commercial banks and other financial institutions to approve or give loans to certain sectors of the economy and leave out others. For example, the agricultural sector will be given loans first, and those who wish to buy expensive luxury items like expensive vehicles are given last or not given it all, hence regulating money in circulation. Raising the cash ratio. Cash ratio refers to the percentage of deposits that is not lent out by commercial banks but kept in cash form. The central bank may instruct commercial banks to keep a higher percentage of the deposits received by them in cash form if there is too much money in circulation. This results in less cash being available with commercial banks for lending and vice versa. Moral suasion/instruction to commercial banks. The central bank may persuade commercial banks to exercise a general restraint, control/limit in granting loans to businessmen if there is too much money in circulation. It involves persuasion, request, appeal, and advice by the central bank to commercial banks to control and regulate the lending policies. 5. Currency reform. This refers to the withdrawal of a given currency from circulation and replacing it with a new currency of higher value. When there is too much money in circulation and losing value at a high speed, the central bank may be forced to undertake a currency reform and replace the old currency with a new one if other measures have failed. Legal reserve requirement. This is the percentage of commercial banks' total deposits that are required by law to be kept with the central bank before operation. During inflation there, commercial banks were required to keep a higher legal reserve requirement with the Commerce money and Banking-1 lending, and as such is law reduced to increase the amount of money in circulation during a deflation. Margin requirement. This is the difference between the value of the collateral security offered by the borrower to the bank and the amount of money advanced by the bank in form of a loan. When there is too much money in circulation, commercial banks are required to maintain a high margin requirement to scare away the borrowers, hence reducing money in circulation. Rationing of credit. This is where the central bank limits the amount of loans lent out to commercial banks. If the central bank wants to reduce the amount of money in circulation, it fixes a maximum amount a given commercial bank can borrow from the central. This reduces/limits the amount of money the commercial banks would give out to the public as loans. 6. Review questions. 1. Define the following terms. I. Inflation. Roman 2. Reflation. Roman 3. Deflation. Roman 4. Devaluation. Commerce money and Banking-1. 3. A distinguish between monetary policy and fiscal policy. B. Explain the methods or tools used by the central bank to control credit. 4. Define the following terms. I. Legal tender. Roman 2. Public debt. Roman 3. Fiduciary issue. Roman 4. Bank rate. 5. Outline any 5 differences between a commercial bank and a central bank.